mission is to bring together top venture capitalists to compete so you have the insights on how the best VCs invest.
It's a little bit of competition. We have this beautiful PrimeTime VC belt. It's not a WWF belt with a logo taped on it. It's a PrimeTime VC belt, custom. We have some winners on the stage as well. So we've been doing this for a while, and we are here to help the founder community understand what the VCs are thinking. So this is what they're competing for. If you ever seen ESPN Around the Horn, basic format, but we're actually having you, the founders, the investors, vote on who's going to win each round. They're going to compete. They're going to debate. And after each round, we will have a vote, and we'll see who moves on to the finals, and we'll kick 2 VCs out, and then there'll be one crowned with this VC belt. So that's how we got here, and that's what we got going on. So let's just do some quick introductions because you'll be able to do it better than I am. And Erica, kick us off, and we'll go down the line.
All right, thank you,
Talk about what you're building, the thesis, and what you're focused on.
Yeah, so great to see everyone here. Love TechDay, love New York City, best tech ecosystem in the world. You know, I've been part of this for 16 years and just love the turnout and the energy in the room. My name's Erica Duignan Minnihan. I am founding general partner of Aubrie Ventures, but more importantly, 2-time PrimeTime VC belt winner. Woo! It's my most important accomplishment in life. But what we do is we are seed stage investors, tech generalists. We focus on leading seed rounds for phenomenal founders, creating disruptive technologies. I'm based here in New York and would love to meet any of you who are starting tech companies after the event.
You should put that on your LinkedIn bio, by the way. PrimeTime, 2-time PrimeTime. Okay, please. Chris.
Charlie, TechDay, thanks for having me back. Won this thing one time. They never actually delivered the belt, so I'm actually just going to put it over here, and just in case, because they never handed it over. Support everything that Erica said in regards to New York City and what's happening here. C2 Ventures, we are seed-focused. We also have a pre-seed fund, 3 funds under management. Enterprise B2B SaaS, dirty, dull, and dangerous industries. We like the really unsexy, unglamorous stuff. Robotic bathroom cleaning, construction, insurance tech, medical tech. If it's not glamorous, and crypto or consumer. Generally, a lot in the north. 60% of our deals are in the Northeast. We see a lot in the Midwest as well. So seed focus, pre-seed, right in about $500,000 to $1 million, launching our 3rd fund, and ready to battle. Good to be here.
All right, Aubrie.
All right, reigning. Can you hear me? Oh, yeah, okay. Reigning last place participant in PrimeTime VC, so it's time to upset these winners.
A great outfit. The outfit takes first place. I love the color.
Outfit and baby's first PrimeTime.
Yay!
I'm Aubrie Pagano. I'm general partner at Alpaca VC. We're a seed stage fund focused on technology reshaping the real world. So that's anything from real estate, construction, consumer, supply chain, anything that touches the products, people, and places that move around our world, we will do. $200 million under management and 4 years as a VC.
Hi everyone, I'm Zehra. I'm an investor at Headline Ventures. This is very ironic. Thank you for whoever cheered. This is very ironic for me because I've been a VC now for like 5 months, and most of my career thus far has been being a founder twice, once successfully, once miserably, and a startup operator. Headline has $4 billion under management. I am part of the team that's investing specifically in consumer, which is very much like 10% of our fund. So I'm really excited by like future of consumer social, future of CPG, beauty, a lot of the stuff that I find really exciting. And yeah, that's kind of everything about me. New York has been very formative in my career. I don't think I would be where I am without the city. I've been here for 7 years now. So thank you guys all for being here, and thank you for having me. I did win the last PrimeTime VC. I'm not sure how. I don't know if that will be the case, but it was really great, and I'm excited to be back.
All right, let's get this thing started. I see Aubrey's already saying she had 2. You're voting for 2 with Aubrie, so she's getting some sympathy votes, potentially. All right, so let's start off with the macro environment, right? VC funding isn't very hot, very cool. It's pretty flat right now, right? As it continues to stay flat, What's your summer capital deployment forecast, and what sector trends look the juiciest? Zehra, you're the defending champ. Please kick us off.
Yeah, it's interesting because I think consumer specifically, which is where I'm going to speak from, is having a very difficult time right now. I spoke to founders 2 months ago who were going out for a Series A between 10 to 20 million. They're now having to shift to a seed extension to do 4 to 6 million. So it's tough because I think in consumer, we're in this difficult time. Investors are looking for more metrics at a Series A stage. It's almost like the metrics you expect at Series A are what's needed at Series B, and it's kind of like this expectation has been put on founders that feels sometimes a little unrealistic. That being said, I do know of a really, really good consumer company that just closed their Series A at 20 million for $110 million valuation. So I do think if we're going into summer, that's really going to get everyone excited again. And then Beehive just closed their Series B at 33 million. While Beehive is not necessarily consumer, since the newsletter writers like myself, I guess, are more like businesses, I do think it is a really positive indication for like the creator economy, solopreneur economy, prosumer, consumer category in general. I think they're all positive tailwinds in an otherwise difficult time for a lot of consumer businesses. So I'm going into the summer positive. I think there are some signals there that feel really good. There are businesses getting funded that are truly consumer, like the one that just signed earlier at that valuation and at that Series A. So once that comes out, I think people will feel excited about consumer again. But yeah, I'm curious to hear everyone else's takes.
Chris, forecast, sector trends.
Yeah, I mean, obviously it's been, I think, a tough last 18 months. Macro, interest rates, inflation. There's been zero liquidity in the market. Once liquidity comes back and IPOs and companies selling and LPs seeing money and GPs seeing money, that's just going to help the entire ecosystem. But the reality of it is good companies have been funded during this entire period. And like, so your highest growth companies have been seeing funding even the last year, and the last year has been very difficult. So I think the headlines maybe tell a different story, but the reality of it is this summer going into 25 will only continue to improve so long as there's sound unit economics, there's month-over-month growth, there's good markets, there's a good market behind your business. Other companies may have struggled just given kind of macro headwinds, but there's generally kind of a grouping of the entire industry and what you may read or hear about, but whether it's seed, which is our focus, or A up, a lot of good funding opportunities. Nothing's stopped. VCs have a lot of money. I think the only major trend is probably capital's just been a little bit more reserved, to be more cautious and a little bit more particular on price points, and prices coming back to normal. And hopefully the Bay Area, which is generally the culprit of inflating companies more than that their value, doesn't do it again.
Erica, I like the shots fired at the Bay Area. Go New York, all right?
We're here to win. We're here to get attention.
Well, I'm bi-coastal, so, go both. So, I think to answer this question, we really have to look at the numbers, right? So there's a figure that we tend to track as VCs called dry powder for the industry, and that means, how much capital do VCs have in their funds left to deploy. In 2022, that number was $375 billion. It's actually down 2/3 to $125 billion today. So while that number is still big on a historical relative basis, it's 2/3 less than kind of like what we're used to in the market. So the truth is that we're still going to see a squeeze. There's not an uptick in, sort of total deployable capital at all. And although deals are getting done, I think everyone needs to be really careful about optimistic expectations, given that, there's a lot of global crisis going on, there's rampant inflation, there's always uncertainty before an election. And we just have such little visibility about the future right now. But the good news is that for high quality revenue growth companies, they're able to get deals done still. And if you have a great company, you're going to, find yourself able to raise money. We have a portfolio company that has, several competing Series A term sheets going on right now. I did not think I was going to see that this year. But the fact is that if you have strong growth, quality revenue, and a path to exit, there's definitely funding for you.
Cool. Aubrie.
Yes. So I'd echo a lot of what people say. another piece of data that we look at is like graduation from different rounds. So from seed to Series A, usually it's around a quarter of the companies graduate in the market. We anticipate that to be way down this year, closer to like 8%. And so there's a precipitous drop in the number of companies that are going to graduate to the next round. I think that's like the bad news. I think the good news is that the companies that will graduate and that are fundamentally better companies. They're companies that have a low burn multiple. They're companies that are reaching profitability or even talking about that, which like 2 years ago, no one was really talking about. And so I think good news for entrepreneurs is if you're building a good company that has sound fundamentals, like you have as good of a shot as anyone else. And the flashy founder who's all sizzle and no steak is actually on an more even playing field than the founder who has like a truly fundamental business. So I think that's all good news for us. And then the other thing that I like to talk about is like when you're raising in the summer, they're actually the VCs who do real work. So it's a good time to diligence if your VCs are going to be there. The VCs that are like off on their yachts in Europe maybe aren't the best long-term partners every way. So it might be a good time to actually go out for capital.
Can I say something really quickly, Charlie? There's also 2 statistics I want to bring up. The first is that PitchBook reported that VCs are now getting comfortable with larger checks again based on the fundraising that happened in April. And then the second is 44% of deals that happened in 2024 were done by General Catalyst and Andreessen Horowitz. So take that, interpret it how you will, but I think it's interesting to hear that, one, there are reports from PitchBook's perspective that VCs are getting comfortable with big checks again. And I think, 2, it is kind of crazy that almost 50% of fundraising in 2024 has been dominated by 2 huge funds.
Nidal, can you please put up the QR code? So this is the first round. We're going to scan that QR code. This is how you're going to vote. You are all a part of this. You're going to be interactive. Whatever resonated with you, you would vote for one of the 4 panelists, and we'll see who won this round. But that is how we're going to do each round. We're using Slido. Shout out to Slido.
Slido.
Do we have any disagreements while people are voting that maybe you could steal this round? Or go ahead, Eric.
Yeah, I mean, I'm not trying to steal the round, just sort of a little riffing off of what we're saying. One of the things I think that's really interesting is just the general lack of liquidity, right? So exits are also at an all-time low, and that ends up having kind of a multiplier effect throughout the industry, right? Because as companies are exiting, other VCs are able to mark their positions in their portfolio higher. The underlying LPs are seeing gains. They're more interested in deploying into the asset class. So, until we start seeing, buyers really coming back to the table, and when we start seeing that happening, I think that's the best indicator for a strong venture capital environment.
Nice. Nidal, can you show the results? All right, 50 votes, and Zehra, our defending champion, is looking like she's the winner of this, 53. So let's clap it up for her. Erica can steal this. If anyone's a big fan of Erica, she's pretty close to stealing this. It's okay. Cumulative votes at the end. Who makes the finals? Who you want to see in the finals? That's where your votes are going to. So round 1 to Zehra. We're going to move on to the second question. You've all mentioned due diligence is coming back in vogue, which is nice. 2021 was a little bit different, right? So before, a typical deal time took 83 days, 118 hours spent with due diligence, and 10 references. But VCs cut some corners and because money was cheap. What trends are you seeing in addressing deals along with your due diligence process? Chris, start us off with this one.
So the questions that we try to dig into first and foremost that I think often are overlooked is why are you solving this particular problem? What makes you the best founder to solve this problem? What's going to make you unique in that journey, the moat, the IP? But a lot of times, and I'm surprised the word AI hasn't come up yet, you see a deck which is, AI. For us, that's a red flag. That should be the 5th or 7th thing in the deck. And a lot of times, I think, founders are excited about AI and they assume that so is venture. But I can't speak for these 3. But at least for us, that's the least of our interest. If AI is a component to your business to create greater efficiency or speed and make your business more profitable or whatnot, that's great. But you're not an AI company. Who gives a shit that you have AI? AI has been around for many years. It just got a lot of attention post ChatGPT, more on the consumer side of things. But from a B2B perspective, it's been around. So for us, we just try to break it down. There's a lot of conversations. 30 inbound a week, a lot of Zooms. But if you just come down to the core, what problem are you solving? Why do you want to solve this problem? And then what was your journey of perhaps past pain or experience? Because the reality of it is most founders are going to fizzle out. They're going to be tired. Things are going to go sideways. Million headwinds, which again, everyone here would agree to that point. But if there's a core fundamental driver of what's making you want to solve this problem, and you have a team to do so, again, it's blocking and tackling. And sorry if the answer wasn't amazing, but those are the most important pieces. And you'd be shocked with how many conversations you have where you actually can smoke things out and realize this team or this company isn't as serious as they need to be to go after the next 10 years.
Aubrie, what about due diligence trends you're seeing?
Yeah. We've seen diligence slow down a lot. So with the slowing of investment pacing, at the height of the market in 21 and 22, we would see deals get done intra-week, where you'd get introduced to the deal and you'd have 48 hours to make a decision. Now, we actually slowed down our pacing a lot during that time because we are slow, methodical investors, and we lost out on a bunch of deals because we refused to move that fast. Our average fund over the last 3 has deployed over almost 4 years. And you cannot say that for the mega funds who raised, within 18 months and deployed several $100 million. And so the fallout of that was it was like Oprah, everybody gets a term sheet. You get a term sheet, you get a term sheet. And there was a lot of mess that needs to move through. And so now everyone's taking their time, which I think is a good thing, and also something for founders to be prepared. Now average cycle I think is 28 days or a month. That matches with Alpaca's historical average. On average, it takes us 28 days from first meeting to term sheet. And I think that's enough time to dig into your company, meet the whole team, reference your, do 10 back references, talk to customers, potential would-be customers, all the stuff that you should be doing to write a big check. And so it's just something for founders, I think, to also know to get your stuff together. Because I think before what we also saw were founders could raise, I can't tell you, on my hand, there was a number of founders who were I don't have a deck, I don't have a deck. They just were I have a great story, I'm well networked, I don't need this stuff. And I think those days are over, which I think is a good thing overall for the industry, but it's also something for founders to note, to have your stuff buttoned up if you want people to move faster, because we can only also move as fast as your data room is full and competent and thorough. So help yourself, help us by being super prepared when you come to talk to us.
To fill that data room, Fidelity Private Shares has a beautiful data room. It's secured, and it will help you with the due diligence process. Zehra, what are you seeing with diligence?
Yeah, I'm going to tell 3 really quick stories, and I swear they're going to be really quick. The first is there is a company that I spoke to that has been fundraising since January, and his last fundraising round was in 2021. He had one meeting with Mark Andreessen and got an insane valuation, insane amount of money in 2021 for a pre-seed company. The same founder is now fundraising, has data and user retention and growth that people are saying for a consumer social app was not even at the same level of early days of Discord, early days of TikTok. The retention is not normal, and people are saying it's a once in a decade social app that has really unlocked some sort of behavior that people love. And this founder went through the toughest fundraising time the last 4 months because of, I don't want to call it over diligencing, but I think to everyone's points, people are a lot more buttoned up right now. The data is the data, and I think founders or investors can get comfortable with it. But part of the problem was diligence and talking to as many users as possible. Just it allowed a lot of investors to find new problems that they otherwise maybe would have been able to look over had it been 3 years ago. And this is a stellar founder. He was part of a team that exited a company to Snapchat. He's amazing. And so just hearing about how tough of a time that he's had, and now he's past it and he has a term sheet and everything. But it's kind of crazy see that that was his experience with diligence. And I think it's just indicative of the environment that we're in. People are diligencing a lot. I think the second, or rather two examples I'll give. The first is for one of the deals I just referenced that closed a Series A, they went from first conversation with 3 funds to 2 term sheets in 6 days. And it's because the business was good. The retention was amazing. The revenue growth was there. The founder was so buttoned up. It was getting on calls with us Sunday evening, going through the data, like showing us everything, and was doing the same with other funds. So I think all of this to say there is a lot of emphasis on diligence right now. I think investors want to feel as comfortable as possible to show all of their thinking when it comes to recommending, like pounding on the table that the firm should invest. So I think those 2 stories are kind of just like, it's really, really depending, I think, on a firm-to-firm basis and founder-to-founder, but it's wild to see the variety of diligence.
Yeah, well, things have definitely changed. If any of you guys watched that really hilarious TV show, We Crashed, you'll see the scene where Masa diligences Adam Newman in like 5 minutes and basically hands him $4 billion. Those days are over, but the important thing to recognize from that is that not only did it not work out for Masa, it did not work out for Adam. And that's because he didn't spend enough time diligencing his relationship with his investor, right? So when we think about the fact that the diligence process is getting longer, I actually think it's better for founders because it's probably not a great idea to take millions of dollars from somebody who you just met 6 days ago and you don't know very well, right? You're basically going into this extremely long-term relationship where they're the new guardian of your baby, right? They're basically like, if your company is your baby, that's their new stepdaddy, right? So you want to make sure stepdaddy is not a alcoholic, abusive, terrible person. So I love seeing the diligence process take a little bit longer. Founders have also the opportunity to get to know the investors a bit more. I'd say right now, 6 to 8 weeks is kind of like the ballpark. And, at Rain Ventures, we really care about people. So for us in our diligence process, we're focusing on founders, team, and customers. When it comes to the founders, my ideal scenario is that I've known you since college, right? I mean, I want to have the maximum amount of time knowing you as possible. And in order to do that, we really focus on building relationships with founders who just have ideas, founders who are in, incubator stage, at pre-seed stage. So we try to make a point to get to know people in the community way before they actually need a check from us. If they don't, have the opportunity to do that, we then are able to dive in and really focus on doing background checks, not like in the, credit check type style, but, talking to their customers, talking to people that they've worked with, talking to their former business partners, talking to as many people as we can just to get an idea of their character. And then, I think that the last step, which is talking to customers, is something that over the last few years during the boom time was really ignored because folks were competing so hard to deals. It felt like an imposition to ask to speak to their customers. But you're seeing that a lot now. And, the customers are actually such an important part of the equation. So it's wonderful to be able to now have the opportunity to really include that in our diligence process so that we can also better be on the same page with our founders.
Charlie, can I just add something real quick?
Did all put the QR code up? Yes, you can say whatever you would like.
On the timing piece, because I didn't do that part, 60 days would probably be ideal for us. But the reality of it is as well as the founder can match the firm based on the criteria. So we had multiple deals in our pipeline that we were diligencing, and we met a founder at ERA 2 weeks ago. I was actually sitting next to Charlie. And we basically reprioritized that deal just given the nature of that business and the construction category and our thesis. So the point is, if a partner really loves your company based on the match and the stage, other things will be reprioritized, and you're still not going to skip over a reference call or a customer call. That won't be skipped over, but other things can get reprioritized. So my point is, I think founders should definitely be encouraged to think about who are you calling and why are you calling them as far as the fit. I think that part has improved dramatically, whereas before it would just be let me meet any VC up here, but no one really knows what they do or what they're looking for. We all want the luxury to meet people for a long period of time, but the reality of it is if there's something that's moving and closing pretty quickly, if it's a good match, the GP that's looking at it will drop everything and make it happen.
Scan that
wanna-
QR code, get your votes in. Aubrie, go ahead.
Oh yeah, I was gonna add something to what you said about like getting in bed with someone too fast. Like I heard this on a panel. I'm gonna re-say it's like if you marry for money, you'll like pay for it the rest of your life. And I feel like it's the same with ventures. Like if during the boom times, like founders were just optimized for price and speed. And like we've seen so many relationships like blow up because of that. Like bad board dynamics, bad pay to plays, bad liquidation. Like the fallout of that has been extreme. So I think to your point that like
I think that's a segue, right, for us?
is it?
For next question, yeah.
Oh,
Good founders will also ask to talk to your founders. It doesn't happen all the time. I'm blown away. I don't get asked this question. I don't know if you guys do more often, but good founders will be like, can I want to reference your founders. And those are good questions to ask as far as the fit.
As
Yeah,
an
definitely. That's
investor-
the number one thing you guys should be doing in diligence is talking to their
references.
portfolio company founders.
Because an investor is basically an employee that you can't fire. And I saw someone tweet that the other day, and I was like, that's a really good way to put it, because it is like, it's such an important relationship.
Let's see the results. All right, Erica. Good job. All right, so we'll move into our next topic. I don't know where that music is. Yeah, oh, sorry. VC beef. VC beef. Very much like Kendrick Lamar and Drake right now, right? I don't know where that music came from. Just trying to get it. Let's see. VC beef. So what do you, as an investor, when another VC is on the cap table of one of your portfolio companies, starts to impact a company negatively? You see this as a VC, you don't like what's going on with this other VC, seems like beef. How often is the drama amongst VCs both invested in one of the same company? When are you seeing the VC beef? How often? Feel free to share stories of VC beef and how maybe you have navigated it. I think we would all like to see that. Erica, talk about some VC beef.
Yeah, sure. So, there are a couple strategies. One is if, you can really only address it effectively if you're a new investor coming in leading a new round, right? So, if you're coming in, you're leading a new round, there's an existing maybe board member who's been causing problems, at that juncture, there's a great opportunity to be able to support the founder and possibly remove the disruptive investor or sort of at another kind of funding increment. So that would be ideal. And we've definitely seen that before where, an investor has put a lot of emotional burden on founders, has been very disruptive to their ability to grow the business, and we think that it's so important for sort of everybody on the cap table to be rowing in the same direction. But most importantly, if they're in the boardroom, right? One of the tools that we also tell our earlier stage founders is that this sort of strategy of inviting everybody and their mother to be on your board or have a board observer seat is pretty bad in the long run. So, be careful around, which investors you're assigning board seats to or letting in. We actually had one portfolio company, we did our initial investment on a sort of convertible security sort of prior to restructuring their board. And when we came in, they actually had 17 people on every board call. And as you can imagine, it was extremely disruptive. So that would be, my first piece of advice if you can. But if it's somebody that you can't eliminate from the scenario, it's important to sort of understand that when VCs are coming in at different rounds, at different prices, with different structure, unfortunately, not all of our interests are aligned at the same time. And we might even have different perspectives on the state of the market now, the future of the market, how much the company might exit for. So, it's really important for us to try to understand where the other person's coming from, try to make sure that, we're open to all perspectives, not just our own, and that we also think about, our own presence in the board dynamic, as to like what are the real reasons as to why, this person is causing a problem or I'm maybe not aligned with them, and really see it from their perspective. Because as Aubrie, or no, I think Zehra said, basically once they're in there, it's incredibly hard to fire them or get rid of them. So at that point, you have to think about it as like counseling.
Let's go down the line here, Chris.
So, yeah, I don't think so. We haven't seen it at seed. I think seed is a very, very unusual time to see disruption at the board. I think this is more at a growth stage when things really company gets really valuable, and then people start jockeying for more position or ownership. So I think the probably the more successful your company, the weirder shit gets. But at pre-seed and seed, we haven't really seen weird dynamics. I do think that the how you avoid all of that is at the leadership, at the founder, or hopefully the co-founders. So the VC should not be in a position to maybe have beef, because the founders have been doing a good job, A, selecting the right partner, but B, also managing to the best of their ability, the dynamics with that other investor. But I think, to Erica's point too, I mean, if you're, most early stage, there's a misconception about how maybe VCs view each other. I generally think it's about a 99% pretty good dialogue. You want to see other good logos on the cap table. You need another partner to be able to talk through if the founder is kind of going off the rails a little bit. So VCs generally are very, I think, healthy in the dynamics of their relationship, both from a deal flow perspective, but also kind of sharing information. And if you're not, that's probably a bit crazy. But if there is beef, which we haven't really been a part of, I think the first thing is to really understand where the founder, CEO of the company, what they're thinking about, and what they're kind of, are they managing it or are they not managing it? But hopefully these guys haven't seen too much of that. But again, I think it's very uncommon at an early stage. Once you start going to A, B, new rounds are coming in, people are jockeying for board seats, and then things get weird from a growth perspective, but not at seed so much.
Feel free to beef with each other. Say that right now, right?
We never beef with each
right.
other.
Come on. Get after it. Aubrie, where are you seeing this? Have you seen this? Tell us.
Yeah, I guess I was going to talk about like almost like anti-beef. I guess I'll give two stories. Like one, I think potentially like the tofu, the worse than beef is like when VCs ghost. Like we've equally seen that where these big platforms that I won't name names, but like you know who they are. So maybe that's my beef. They will come in they have for the last couple of years come in at the early stages. A's and B's weren't happening, so they were like, we'll go into seed. And we've seen several where, there was a company that was founded by, starts with an A, ends with a Z, and they ghosted. Like they ghosted that team. And we've seen that over and over again. So like, it's like, is it worse if you have beef on your board where maybe your investors don't get along, but you ultimately have the say as like the company, or they just stop showing up? Like in some senses, I think that's maybe worse because you don't have your investor advocates around the table. They don't have context for when they have to make important decisions about your company. So that's one thing that we've actually seen more of too, is maybe not as much beef, but like, this tofu anti-beef ghosting scenario. And then the other that I was going to say around what you said about like how to navigate beef, because like people don't agree, right? Like adults don't agree all the time. That's like part of being a board, is if everybody aligned, you're probably not doing something that exciting. But there's like the board meeting, and then there's like the meeting before the board meeting. And there's like trust and relationship. And like the biggest thing I've learned, because I used to be a founder and now I'm a VC, is like, it's not about being right, it's about being heard. And so it's really about like, how can founders be heard by their investors? And like, how can you as an investor have influence and be heard when those things matter? So I had a founder who was raising a Series A, and they got a shitty term sheet. Like in the sense that like they got the number they wanted, but the restrictive clauses were unreal. And because I had built this relationship with this founder, I got him to walk from the deal, right? Like he had it like in hand, and he was like, but And I was like, no, let me show you why this is like really bad for you. So he ended up walking, and they ended up coming back and being like, actually, we can move on these. And so like, I don't think we would have gotten to that outcome if we hadn't built a relationship like built on trust. And we're able to.
Did you accept the second term sheet that they lowballed you the first time?
We accepted the third, which is crazy. We like went back and forth. I mean, it took like a month but we got there. So yes, they are. So now I have to be on the board with this bad negotiating VC firm. So that should be interesting.
Zehra.
Yeah, I think I have not yet seen beef anywhere, like either at my fund right now or any of my angel investments so far, and I feel very lucky about that. I think it's particularly because the founder, to our earlier conversation, is so diligent about choosing people that they know will not cause problems like that. That being said, this whole conversation reminds me of a tweet that Jenny Fielding sent out, and she said that she had gotten heavily diluted and kind of like screwed out of a liquidation option after one of her companies. I think he did either like an A or a B. And I think like her whole point of that was at the end of the tweet, she was like, I have a list. Like I remember when things like this happen because she is like an incredible pre-seed investor, has an extensive portfolio, has done a lot for the New York City ecosystem. I love her. She was like my professor at undergrad. She's the reason I'm in VC. So I'm heavily biased, but I really trust her judgment when it comes to like people that have kind of either wronged her portfolio companies or wronged her directly. And I think to kind of bring this back to the point of like VC beef, I think it's more you have to think long term. A lot of players in the ecosystem are going to be in VC for like a decade at minimum to see the results of their investments. Most people are in VC for many, many more years than that. And so I think it's kind of just like always thinking long term, never being rude, mean, ghosting someone. Like it sounds like basic things, but now that I've been in VC for 5 months, it is kind of bizarre to see like the VCs who ignored me a year ago who are now talking to me and asking for introductions to founders I'm talking to. And it's kind of, it does, people reveal their colors. And like Jenny tweeted, I too have a list of experiences in my head. It's not a written list, but I think just knowing how people behave and the things that they do that maybe don't reflect the best opportunities for business or someone that you won't necessarily want to actually like recommend a founder to. I've had that happen a few times, just given some bad instances, but it hasn't yet happened on like a cap table perspective. But yeah, I think just think long term. I also, is there a VC associate question that we're talking about or no, Charlie? Okay, there was the other thing that I'm just going to mention really quickly is a founder tweeted that if you talk to an associate, the investment's going to go nowhere, and that was a whole VC beef conversation that happened like 2 to 3 weeks ago. Yeah, so I would just also say, I think from a VC beef perspective, never like be rude or mean to like an analyst or an associate because they're typically the people who can lobby and get like a deal over the board or get like a GP to pay attention. Was that a dog? I know, not that one. Yeah, but basically TLDR, I think just be kind to everyone, very like basic answer, but I think that's what I'm leading with right now, and I'm trying not to ghost anyone, even if it means I'm like staying up till 3 a.m. doing emails.
Nadal, put the QR code up. Chris, you had something to say?
No, I mean, I think a lot of founders are realizing that it's not just the big marquee names that have been around for a long time that are kind of the obvious choices, that there's a lot of smaller boutique funds. It, again, depends on the match and the profile. But I think the days of just thinking, like, here are the top 20 big logos that we've kind of heard about are the only companies that you want to work with, I think that's changed a lot. And they're looking for more customization based on what the company that you're building and the match with the GP. And smaller funds can be a lot better and more agile than a household name that's been around there for a long time.
And I think one thing Chris mentioned before that I think makes a lot of sense is that at the early stage, people are generally really collaborative. Like VC firms are pretty collaborative and supportive of one another. I think the real sharp elbows come out usually at the later rounds. So hopefully we get to avoid a good deal of that.
Let's see the results. We are on a, there you go, Aubrie. All right. You guys want to clap it up for Aubrie? Yeah, let's give her a round. There we go. Yay. Not last place anymore.
This crowd's brutal, Charlie.
Yeah,
with
jeez.
Me. I mean, like, I can't figure it out, no matter what I say.
Chris.
Yeah, Chris, you stink.
I mean,
congratulations. It's all right. He's a great VC. He's not doing great on the panel right now. It's all right. We're gonna stop at 5, so we're gonna move this along a little bit more. The last question here for the first round until the finals. What's an unconventional question that you ask founders to better help understand who they are? More importantly, why do you ask this unconventional question? Talk a little bit about the psychology of getting to know that founder and what that question is. So, Aubrie, congratulations on winning the last round. Go ahead.
I guess, can I give 2 answers?
You do whatever you want.
Okay. There's 2. Well, because there's kind of 2 sides to it. One is I ask, to have this company be really big, like a lot of things have to go right. And so I ask the founder, like, what do you think is at risk of not going right for this to not be huge? And so what I'm trying to get at is, like, are they self-aware? Like, can they talk a big vision and also talk to me in a convincing way about something that is a convincing risk? And am I aligned to what risk they're seeing? Because what we always underwrite is risk, right? Like, there's no startup that you invest in at the early stages that doesn't have any risks. And so if a founder can't tell you any risks, it comes off as naive. And if the founder tells you a risk, that sounds like, when you go on an interview and it's like, well, I just try too hard. That's my biggest flaw. Like, that's also a bad sign. And so if someone can convincingly and honestly talk to me about real risks they see in their business and what they're going to do about it, they can impress me more in that way. And then the follow-up thing that I do too, I try, if there's time, is to actually have a working session with the founder to go through their product roadmap or their finance, and I'll intentionally poke at stuff to see how they deal with someone questioning them. And again, I think someone who's really confident and very competent doesn't mind that and can have a really good back and forth. And I think it's a chance to test our relationship to see what it's going to be like, and we get to kind of try each other out. So those are the things that I do.
Zehra.
Yeah, I think the questions I'm thinking of, I ask when we're like past diligence, and it's mostly because I want to get to know the founder as much as I can. So I ask one, what is an undying loyalty that you have? And it's very interesting to see how people answer that question. Like, my answer is my AMC Stubbs membership because I love going to the theater. And then 2, I always ask, what did you want to be when you grew up, like as a child or whatever? Because it's really interesting to kind of understand people there and their perspectives and what they wanted to be. And so these are less like diligence-y practical questions, but I always love to ask the founder when we're like post-diligence, right, about the way that Headline operates. Our investment committee is like one meeting with the founder presenting to the investment committee and then an actual investment committee with just the investors. And so I always love to ask that question right before it to kind of like get the founder like thinking not as stressed, like make them feel a little looser, and also just to get to know them better. I think it's a really interesting question. I'm going to pose the undying loyalty question to everyone, and if we chat after this, I would love to hear your answers because, yeah, I think it's interesting to hear what people think.
The New York Knicks.
I knew you were going to say that. I knew you were.
It's obvious.
I think we try to understand a point in time that the founder faced adversity and how they dealt with it. It's more so just to unlock a little bit about how they think. If there was a significant problem or something, in a previous career path, what was it and how they dealt with it. And then back to what I mentioned earlier when when we were talking about diligence, and I answered this question instead for some reason. It just comes back to the there's a million different things that you could be doing. Why do you want to do this? Why do you want to do this now? I think when you get lucky, it's like, all right, well, I actually worked for my dad's business and saw this, and this was broken, or, I tripped over this. The founders are going to like literally go through kind of hell and back, right? So you want to understand, like, are they willing to like jump into the building that's burning? And I know that sounds dramatic, but that's kind of, a lot of founders in today's era, Eric, I don't know if you agree, like they kind of quit earlier. Like, when I was the founder back in early 2000s, you just kind of stuck with it longer. So we're trying to smoke that out a little bit and try to understand, like, okay, there's a little bit of adversity, or you're going to be like, I'm just going to soft land this thing. Like, thank you. Wait, that's not what we thought we were going to be in this for a long time. So we try to figure out, and we get it wrong often, but who's going to stick with this? And if there is some past pain or experience that emotionally they were connected to, they're going to be way more inclined to navigate than like, yeah, me and my buddies thought this idea would be cool. Like, that's out.
That's great, Chris. Totally agree. So, we tend to ask our founders two relatively unconventional questions. So the first one is that generally we prefer to invest in companies that have more than one founder. So we'll always ask the founding team, whether it's 2 co-founders or 3 co-founders, tell us about a time that you guys disagreed on something or had a really difficult challenge to navigate through together, right? It can be whatever it is, but tell us about a terrible time in the business and how did you guys get through it and get on the same page? And we think that's really important because it gives the founder an opportunity to have some vulnerability, and it shows us how they work together as a team and how they're able to sort of co-navigate decisions. And does this co-founding team sort of have what it takes to make it together for the long term? So that's to show vulnerability. And then the second thing that we ask is to allow them to show us themselves kind of in their highest state. And it sort of starts with a question, which is, are you interested in 5 to 10 years? Are you interested in selling this company, or do you want to take it public? And whatever you want to do in 5 to 10 years, describe to me what that looks like. And it gives the founder an opportunity to really share with us like their vision, their excitement. We can see, have they really thought this through to the end? And do they have like an end goal in mind? And for founders who, have that long-term vision to actually take their company IPO, I mean, that's pretty exciting, right? Like we want to see how much energy is there. And even if it's a company that they're expecting to sell, and we know that, I think 99% of venture exits end up in some sort of an M&A sale, we still want to see what is getting them excited about that vision down the road, and do they actually know where they're going on this sort of 5 to 10 year journey that we're taking with them.
Yeah, and Charlie, on that note, the days of your company selling or flipping for $250 million or $300 million in 3 to 5 years, they're over. There's no really good sound business that it's going to take. So that we tell our LPs 9 to 10 years, maybe it's 7 to 8. It's not to say that it can't happen, that a company can't sell and there's good returns in 5 to 6, but for the most part, I think there's been some consistency on the panel in regards to the bar being risen and like the metrics that matter, like good financials, good unit economics, like good TAM. Whereas before it was like the WeWork example, which is when I do pick on the Bay Area. I have a lot of friends in San Francisco, but there are 4 or 5 firms that generally throw money indiscriminately, and those things happen. So the hold for companies take a lot longer. So when we talk to founders, it's like 10 years. It's a real, maybe it's, and then sometimes you kind of realize like, I don't know if I want to do it this long.
This is the final vote before the finals. I see Zehra is trying to cheat and get a fine, get an upper hand.
And kind of on the note of what Chris said, which is so interesting. So one of our LPs is Jason Green, who's the GP of Emergence Capital, one of the top performing VC firms of the last decade. And he said with their Fund 1, they actually had no idea if the fund was actually even going to be any good until 12 years in. And I just thought, oh my God, like that's crazy. That literally one of the best performing funds, of the last, I guess, 15 years, it took them 12 years before they even knew if it was going to be any good. So
and on top of that, and I don't know who said this, so no credit here. The other thing that I heard was the companies that you believe from a GP perspective, the ones that you believe are going to be the winners are not. So like you look at 3 or 4 today, you're like, oh, these are our best companies. I mean, maybe a couple, but it's other ones that kind of rise and navigate, and I found that very surprising because I thought we always had a really good handle of, kind of if you broke them down in like 4 tiers, and apparently we don't know. That's what I'm being told.
So that's actually terrifying because he said for that fund too in the beginning, the first few years, They had ranked their top 5 portfolio companies. It was a portfolio of 20 companies. So they ranked their top 5 and their bottom 5. And they said their top 5 ended up being their worst and their bottom 5 ended up being their best. So clearly even the best VCs like have no idea what's going to work out or not. So
there's luck involved.
Let's see the results of this question, which is not. There you go, Chris.
Finally.
The pity vote. There you go. You got the pity vote.
Have a tough Friday.
It's looking like it's going to be pretty close for who's in the finals. I will say, to answer the question, what I recently heard from a VC is, when's the last time you cried? They've asked the founder. That was pretty interesting. I don't know, like pretty vulnerable. Who's making the final? Aubrie, congratulations. The first time you made the final. And defending champ, Erica. There you go. So Chris and Zehra, you stay on.
Okay.
You'll chill if you want to do some banter. But we're going to do this a little bit more rapid fire. We'll do the vote at the end, and then whoever wins gets the title belt and gets to preach and do a little speech to you guys, right? All right, so pre-seed investor, what does it mean to be a true pre-seed investor? What are the personality traits, skills needed to invest into early-stage companies? Basically, how should founders look to identify a true pre-seed investor? Erica, go ahead.
So I always say if you're a pre-seed investor, you're either a saint or a masochist. Pick your poison, because it is definitely by far the most difficult asset class to invest in. It is so hard to, see whether or not the company's going to get product market fit. You're basically going off of an idea and possibly founder market fit and extremely little validation. Also, there's not a whole lot of compensation for folks between the pre-seed and the seed round in terms of valuation appreciation. So they're doing a lot of really hard work for not a lot of financial return. So you got to find people who are doing it for the love of doing it, right? Probably people who used to be operators, people who just really love working with early stage founders. So that would, sort of be in the saint category, or the masochists. They just really love doing a lot of hard work and, enjoy the pain of it. But I would say that a great pre-seed investor is somebody that you should be eternally grateful for. They're probably hoping to eventually, move into a later stage.
Aubrie.
I think there are 2 kinds of pre-seed investors, and maybe I'll go with the angel and the devil. There are what I would consider like the tourists at pre-seed who can't raise a big enough fund. And so they have like a Venmo account and a cell phone, and they are now a venture capitalist, and they will give you money, and they are not really proven as an operator or a venture investor or have good networks or have anything to bear, but they have a check. I would say to avoid those like the plague. I think what's cool about pre-seed investors is that they have to be like highly like emotionally intelligent people. They have to have a really high IQ, because it's all about team. Like that's what you're betting on. You're betting that this team has what it takes together to build in a space that they may not even be building in right now. Like the amount of pre-seed companies that we backed where the product that they pitched us, they didn't actually build. The market that they were in is adjacent to the one that they actually went to market in, like is vast. And so for pre-seed, it's really about how much time you spend getting to know the team, and is that team like put on this planet to build together for a big problem. And so we think about, has that team shown an ability to be exceptional in some way? You could be and have been an Olympic athlete, but it shows like your drive, your willingness to break through walls. Have you shown an ability to hire and inspire people? We kind of talked about that earlier. Like hiring's the most important thing that a CEO can do really well. So it's like, how can you prove that? And then the third is like, do you have any kind of like prior art that you've been successful at something, in the business world? Like obviously second-time founders have an easier time with pre-seed because they've proven themselves already, second, third-time founders. And so what can you show to a pre-seed investor that you like can do it, if it's not through business, through some analog, through your nonprofit, through your community organization, through whatever. I think those focusing on team is ultimately what we've seen at the pre-seed win.
All right, rapid fire, safe agreements, common investment vehicle in the early stage. What are some of the unforeseen pitfalls when dealing with a SAFE agreement, and what should the founders look out for? Aubrie, stay with you. We're going to cut it back a little bit.
Sorry, yeah. Safes. Safes delay, in the same way that money can hide problems, safes can hide true value of a company. And so safes, the benefits are they're quick, they're easy, you can wire tomorrow, you can get people in. The cons are you are not pegging your company to any real value. Safes can move very easily. They can create kludginess in rights for the founders that come back to bite you at later rounds. And so you kind of get speed, but the trade-off is like certainty around investor rights, board construction, and pricing.
Erica.
Yeah, so for those who don't know, the SAFE is a simple agreement for future equity. It's a security that was invented by Y Combinator, I don't know, maybe like 20 years ago or something like that. Maybe a little bit less than that, maybe like 15 years ago-ish, between 15 and 20. It became commonly used and trendy because Y Combinator was like super trendy, and so everyone just wanted to copy what they were doing. And in fact, when the SAFE first came out, other startups started using a SAFE so that people would think they're in Y Combinator. Basically, it was sort of like tricking you, like, oh, I have a SAFE. I must be a YC company, even though they weren't. So I thought that was kind of funny. But in general, I think time has shown that it's not a great instrument both for investors or for founders. From the investor side, you're not in a good position because you have pretty much no investor rights. You don't even really hold equity. There's no board governance in place. What sort of your valuation is uncertain until forever. And a lot of founders, if they're successful raising on safes, they get a little bit addicted to them. It's sort of like, the drugs of startup fundraising securities, and they'll just keep like stacking safes one on top of another. I mean, I actually have a portfolio company that has stacked, I can't even imagine how many safes by now at ever increasing valuations, which is not a great situation, I think, both for a founder or for an investor. So I used to be sort of pro to indifferent on safes, and now I'm definitely anti-safe.
People can also redeem them. We had one investor in our company actually redeem a safe.
Closing out the round. Chris, quick.
Quickly, I think we're not a hater on them, but I think it's important to understand when with a lawyer, like what things look like pro rata, when pro forma when they convert on a future round. A lot of times that's not done. So it is quick, and there are benefits there, but some pre-work needs to be done to understand what the cap table looks like pre and post to try to remove some of those issues.
And if you want to execute on a safe, Fidelity Private Shares can do that too. That's nice, right? Closing out the round, we're going to ask a little bit about closing out a fundraising round, right? As a founder, you've met with a million different VCs. You're looking for investment. Some are on the fence, some are not. What's the best way to get that over the finish line, and strategies to convert investors who are on that fence while keeping the momentum? Erica?
Yeah, so people usually tell you it's all about kind of creating a sense of scarcity, making people think that your round is almost filled. But, sophisticated investors generally, like, we're not falling for that. Like, we know that scheme. We know that you're not anywhere near oversubscribed yet. And, the truth will come out and you'll just be like maybe mildly embarrassed. What I would say is the best strategy for converting new investors is to get your existing investors, and particularly people who are committed to the current round, to talk to them. Say, hey, we've got such and such amazing person who has already completed this round. They'd love to maybe spend 15 minutes with you to talk a little bit about why they decided to become an investor. I think for me as a VC, for our portfolio companies, for whoever, that's actually the best strategy to converting new investors.
Aubrie.
Yeah, and if you can do that by saying that your last investors are investing super pro rata, to our ears that says they're not bowing out of this round. They're not just paying up to keep their ownership. They're like investing more. That's like a huge, I don't know what the right word is, chip, feather, something in your cap. The other thing I was going to say is companies, the thing that I always tell my companies is you as the founder create your own momentum so much of the time until the company has product market fit. And so the best way to, I think, get a investor over the edge is to create momentum during your fundraise in your core business. So timing your fund, there is a little bit of dark arts to this, but like if you know that you have a big client that's gonna sign, don't go out and raise saying that customer is still 2 months from signing. And don't go out and raise after that person is signed. Go out and fundraise, and just as you're about to get to the term sheet, be like, our biggest client has just signed. That creates a momentum in the round psychologically to us to be like, maybe there's something to this company that we haven't seen. And so thinking about strategically how you can keep the wheels on the track and create momentum for your company, I think really gets someone who's on the fence like over the line.
The results are in. Nidal, who is the winner of Primetime VC number 33? Please show us Aubrie. How about that? How about that, Aubrie? Nice job, Aubrie. Aubrie, please take the. Chris, this was not yours.
I'm gonna take my belt and then give it to you when I'm done.
Yeah, it's not yours. Not yours. Can you please? Can you please give us a little pep talk for the founders? Just winning. Yeah, a little winning speech. Just pump up the founders before we get drinks at Selena Hotel.
Oh my gosh. Well, thank you guys for believing in me.
You knew you could do it.
My first win. This is so exciting. Let's see. You guys are in the best city to be starting companies. That's what I will say. New York right now is on fire. We see more and more VCs every day coming here to spend time with us. And there are so many successful companies here in this town that have so much talent that is ready to be picked off. Because like we said, there is a lot of turnover happening right now at the later stages. And so there's a huge talent pool for your new companies and a lot of capital coming to visit. I've had more VCs from San Francisco say, no, we'll come to you in New York. And so it's a great time to be a founder in New York.
Awesome. Thank you, everybody. Thank you, Walter.